Hello, welcome to Chapter 10, Introduction to Risk Models. So far, when we've been dealing with time value of money type problems, we've been given an interest rate or a discount rate typically, and inquiring minds among us might be asking, how did that interest rate or discount rate come to be specifically? Well, it came to be through market mechanisms, but also through modeling risk for potential investors in any given problem. So we're going to look at some of the models behind this in this chapter for both fixed income investments and for equities. So without any further ado, let's get this show on the road.
Okay, so we want to start by measuring the financial risks of individual projects, single projects. In general, a good characterization of risk inside finance, outside finance is just measuring the predictability or uncertainty of future performance. So translating that into finance, we're going to be looking at measuring the uncertainty of future cash flows or the uncertainty of return on our investment. And in the last chapter, we introduced some of this by looking at the risk of Treasury securities. Now we want to consider the financial risk of a single general financial project. So the financial risks for single projects are at a high level all listed right here. So let's go through them quickly. So first we have duration. That's going to be featured in all financial projects, including treasury projects, including any old project. And what it's really getting at is the increased probability of a bad outcome with the length of the project. The farther we go into the future, the riskier it becomes because, as Yogi Berra said, the future is hard to predict, especially because it hasn't happened yet. Second up is our risk-free risk, which we looked at in the last chapter. That's going to be included with all financial projects, and that we typically can measure in one way or another with treasuries, and it's getting at inflation, interest rates, and default risk, as we looked at in the last chapter. And our third risk is industry or market risk. And this is going to include all non-treasury projects. So any financial project that's not a US Treasury project. And that's going to be looking at things like an industry-wide disruption or a market-wide disruption, which is probably very similar to a macroeconomic crash or something like that. And the fourth and final risk for us to look at here that all single projects include is what we call project-specific risk. This is also for all non-treasury projects, and this is going to be looking at, in particular, risks that are unique to this project. So it might be, in particular, if we're looking at a car manufacturer, bad management of the car manufacturing company. If we're looking at a startup, losing a contract, that type of thing. So we want to, going forward, incorporate these risks into our financial models. And for the rest of the term, any project that we're evaluating, we're going to be evaluating it based on its future cash flows. So we're going to be working in the most general cases with something like the present value of the cash flows is equal to, for each stinking cash flow, first discount it to t equals 0. After you've got them all discounted to t equals 0, add them up. And we could say the same thing with CF0, which is just our cash flow at t equal 0. Okay, so this is very important because for the rest of the term, we're going to be evaluating projects using these equations and simpler and other versions of these equations that we derive from them. So this notion that these are the only equations that we're using, essentially, this suggests what? That we're going to have to measure the risks of a project either in, what are our choices here? Our cash flows or our interest rate or discount rate or both, okay? And one other thing I'd like to throw in here, let me just throw in that duration risk is automatically built in with t exponent. So that's kind of nice. So other than that, all of our risks are going to have to be reflected in our cash flows or our discount rates, our interest rates, or both. And that notion is, of course, correct. So what are our choices? We can put all of our risks into our cash flows. We could put all of our risks, model all of our risks in our discount rate, or we could put some risks in cash flows and some risks in our discount rates. And for any model, any risk model that we're building, we need to measure all the risks. What are all the risks? All the risks are the risks listed on this page. And we don't want to double count. So we don't want to measure risk once in a cash flow and then double count it by measuring it in a discount rate. Let's see how specifically these four risks are measured in our discounting equation. So again, here are our discounting equations, right? Okay, and again, we're going to be evaluating projects for the rest of the term with equations like this. So how does everybody in the world pretty much agree to measure the risks? Pretty much everybody in the world is going to measure in the interest rate or the discount rate risk-free risk, and remember that's our treasuries, and industry or market risk. And then again, pretty much everyone in the world agrees that in our cash flows, we're going to measure that project specific risk. Okay, that's what I've been calling the, let's put that there, stupid manager risk, right? That's our project specific risk, okay? And as I indicated on the previous page, our duration risk is measured automatically by having t in the exponent here. So the longer the project goes, the more risk we're going to have in there. And that comes built from the math of these equations. Okay, so let me just give a quick note on our interest rate or discount rate here. So we're including our risk-free risk and industry or market risk in R. And when we do that, we're going to start writing R as RM or ROCC. And ROCC is short for opportunity cost of capital. So, and up here, M is for market or industry. So these two are going to be equivalent, okay? And as usual in different textbooks or even different chapters of different textbooks, these two things switch. So you've just got to remember that these two are equivalent. You see RM, it means ROCC. See ROCC, same as RM. All right, so now let's also do a quick note on cash flows. When we're including our project-specific risks in cash flows, which is all the time for us, the cash flows are going to be called our project risk-adjusted cash flows. So you'll see that term a lot. Okay, so just a couple things to keep in mind with modeling the risk for our interest rate into our interest rate and discount rate and cash flows. So now with all this in our pocket, let's look at a couple of risk models. The most important one for us is going to be called the opportunity investment model. Economists would call this an opportunity cost of capital model, okay? And or they might write it mathematically like that, an ROCC model. And this is a great model because it gives us a really straightforward method for computing our RM or ROCC. Why do we care about that? We care about that because that's what we're going to be plugging in to these equations going forward. Okay, so it's going to be really helpful to give us that. And the key great features of this model are, first of all, it works pretty well, which we'll see in a second. And secondly, also very important in the real world, for many projects, it's really easy to construct what we need to construct using empirical data. There's a lot of risk models out there that seem really elegant and way super cool, but you just can't apply them from using real world data. Now let's go back to macroeconomics. And I know some of you haven't had macroeconomics, so we'll start from the very beginning and ask the eternal question, what is our beautiful opportunity cost of capital? So hopefully this is what you learned, those of you who've had macroeconomics. And again, if you haven't, you don't have to worry about it. It's a discount rate that aims to measure our risk-free and market or industry risks. It's always going to be written as ROCC or RM, and also economists will truncate this, abbreviate this a little bit by simply saying cost of capital rather than opportunity cost of capital. So just good to know when you hear someone talking about cost of capital, they mean opportunity cost of capital. Okay, so now let's get a formal definition for this. And you know the story, the song remains the same. What do you do when you see a definition? You have to memorize it for this class. So what's our definition, formal definition of opportunity cost of capital? And this also should be completely consistent with Macroeconomics 101. It's going to be the known interest rate or discount rate for a diversified set of alternative projects with similar risks. So known interest rate or discount rate for a diversified set of alternate investments with similar risks to a project that we're considering at this moment. So there are, in this model, we need to apply a lot of assumptions, okay? And all I want you to know on this page, I'll leave it to you to look it over as much or as little as you want. All I want you to know is that a lot of assumptions are needed, and some of which are dubious. Okay. So in general, to apply this model and get our opportunity cost of capital with it, we have to assume what in finance is considered mildly imperfect, inefficient market conditions with some mildly irrational investors. Okay. So the market is going to be a niche. And there's going to be, for example, no transaction costs, perfect liquidity. Both of these are clearly bogus assumptions, right? But we go ahead and use them anyway because the model results, even with these bogus assumptions, is pretty good. Okay, so again, all you really need to know on this page is that a lot of assumptions are needed, some of which are dubious. And you'll see as we go on in the term, the more sophisticated our models get, the more assumptions that we need, and the more dubious or even bogus assumptions we're going to have to put into the models to make them work.